If you watched our SanDisk video, you already know one memory chip stock that turned a tiny investment into a life-changing amount of money this year. But here's what most investors completely miss. SanDisk isn't even the biggest story in memory chips right now. There's another company, one that just crossed $1 trillion market capitalization, that supplies a completely different type of memory, the type sitting directly inside the AI chips made by NVIDIA. Its stock is up roughly 700% in the past year, and it just signed one of the most important AI infrastructure deals of the entire year. Let's find out what's really going on with Micron Technology. If you're new here, we just covered SanDisk and the NAND memory shortage. So if you haven't watched that one yet, go check it out first, since it sets up a lot of what you're about to hear. Either way, subscribe so you don't miss the rest of this series. Like this video if memory chip breakdowns like this are useful to you, and comment below which stock you want us to cover next. Let's start with the most important distinction of this entire video, because it's the one thing that separates Micron from SanDisk, even though people often lump them together as the same story. SanDisk makes NAND Flash memory, the type of chip used for long-term storage, the place where data sits even after you turn the power off. Micron makes both NAND Flash and something else entirely, DRAM, short for Dynamic Random Access Memory, which is the fast, short-term working memory a computer or server uses while it's actively processing information. Here's why that distinction matters so much right now. Every single AI chip, including the ones made by NVIDIA, needs enormous amounts of a special, ultra-fast type of DRAM called High Bandwidth Memory, or HBM, sitting directly next to the processor. Without enough HBM, even the most powerful AI chip in the world can't move data fast enough to actually use its full processing power. Micron is one of only 3 companies on the planet that can manufacture this critical component, alongside SK hynix and Samsung. That's it. 3 companies control the entire global supply of the memory chips that make modern AI possible. Now let's tell the story of how Micron got here, because this company's history explains a lot about why it's positioned so well today. Micron was founded back in 1978 in Boise, Idaho, starting as a small semiconductor design consulting firm, before evolving into one of the world's largest memory chip manufacturers. For most of its history, Micron operated in one of the most brutally cyclical corners of the entire technology industry. Memory chips have traditionally been treated as commodities, meaning prices swing wildly based on supply and demand. And companies like Micron have lived through boom years followed by painful downturns, more times than most investors care to count. This cyclical reputation is exactly why, for decades, Micron traded at a relatively low valuation compared to flashier technology companies, even when its business was performing well. Wall Street simply didn't trust memory chip profits to last. That skepticism is exactly what's being tested right now. And so far, it's being blown apart. Let's get into the numbers, because they are honestly staggering, even by the standards of this AI boom. In its most recently reported quarter, Micron's revenue came in at $41.46 billion, crushing Wall Street's estimate of $35.84 billion, and representing an increase of more than 4 times compared to the same quarter a year earlier. CEO Sanjay Mehrotra pointed directly to soaring demand tied to artificial intelligence infrastructure as the driver behind this explosive growth. Gross margins have expanded dramatically alongside that revenue growth, with the company guiding toward margins near 81% for the following quarter, an extraordinary level for a business that used to operate with margins in the 30 to 40% range during a typical year. But here's the number that changes everything about how you should think about this company going forward. For the current quarter, Micron guided for revenue of approximately $50 billion, up from just $11.3 billion in the same quarter a year earlier. That's not incremental growth. That's a business transforming in real time. Micron's market capitalization has now pushed past $1 trillion, officially placing it in the same rarefied tier as the largest technology companies in the world. This is exactly where things become interesting, because Micron didn't just benefit from favorable pricing, it moved aggressively to lock that advantage in for years to come. The company has signed 16 separate long-term agreements with major customers, including data center operators and automakers. Agreements that lock in committed sales volumes for 3 to 5 years into the future. Management has said it expects roughly half or more of total company revenue to eventually be covered under these binding long-term contracts, representing financial commitments with approximately $22 billion. Some reporting suggests Micron's broader book of binding, multi-year AI memory contracts has actually reached closer to $100 billion in total value, effectively selling out its entire HBM production capacity through the rest of 2026. This is what Wall Street isn't talking about enough when people write off memory chip stocks as unpredictable. For decades, the entire investment case against Micron was that its profits couldn't be trusted to last because of industry cyclicality. Locking in years of committed volume and pricing at a moment when demand is this strong is a direct attempt to break that historical pattern. The exact same strategic playbook we discussed with SanDisk's new contracts in our last video. When two major memory manufacturers pursue the same structural shift at the same time, that's a signal the entire industry may be entering a genuinely different phase, not just riding a temporary spike. And then there's the news that sent this story into an entirely new gear. Micron recently announced a multi-year AI infrastructure partnership, becoming a primary supplier of memory and storage for next-generation AI workloads for one of the leading AI labs, working together to co-design HBM and storage systems specifically optimized for advanced AI models, while the AI lab also invested in Micron's business relationship through equity participation. Partnerships like this tell you that Micron isn't simply selling a commodity chip to whoever pays the most. It's becoming a deeply embedded technical partner inside the infrastructure of the companies actually building the most advanced AI systems in the world. Let's talk about why bulls believe this stock could keep climbing from here, because the case is genuinely compelling. The first reason is the sheer scale of the supply and demand imbalance. Management has been direct about the fact that new manufacturing facilities won't meaningfully add supply until fiscal 2028, meaning the current shortage of advanced memory chips isn't getting solved anytime soon. Industry estimates suggest the total addressable market for HBM alone could exceed $100 billion by 2027. When an industry expert essentially says supply cannot catch up with demand for years, that's an unusually long runway for a company positioned to benefit from the shortage. The second reason is Micron's aggressive push into next-generation memory technology. The company has already begun shipping HBM3E chips and started testing HBM4, the next-generation standard, with volume production targeted for later this year. Micron is explicitly targeting somewhere between 20 and 25% global market share of the HBM market by the end of 2026, a meaningful jump for a company that historically trailed SK hynix in this specific category. The third reason is diversification beyond AI data centers. While server and data center demand is driving most of the current excitement, management has pointed out that AI adoption is also raising memory requirements in everyday consumer devices, with AI-enabled personal computers now needing significantly more memory than older models, and flagship smartphones following the same trend. That means even if data center spending eventually cools off, there's a secondary wave of demand building in consumer electronics that could help sustain elevated memory prices. Now, just like we did with SanDisk, we need to slow down and talk honestly about the risks, because a stock that's risen roughly 700% in a year does not go up in a straight line forever. The most obvious risk is the same one that's haunted this industry for decades: cyclicality. Micron's own long-term contracts include structures designed to reduce this risk. But the fundamental reality remains that memory chip pricing has crashed dramatically during past downturns, sometimes with very little warning. If AI infrastructure spending slows meaningfully, or if a broader economic slowdown reduces enterprise technology budgets, the same pricing power fueling Micron's current results could reverse faster than investors expect. The second risk is competition and capacity expansion. Samsung and SK hynix are both racing to expand their own advanced memory production, And Samsung, specifically, has been working through quality challenges in its HBM manufacturing process. If either competitor solves its production issues faster than expected, or if all three major manufacturers collectively add too much new capacity at once, the current shortage driving prices higher could ease sooner than the multi-year timeline management has described. The third risk is valuation and volatility after an enormous run. With the stock up roughly 700 to 750% over the past year, even a modest disappointment in future guidance could trigger a sharp, fast pullback, since so much future growth is now priced into the stock. Some analysts have specifically flagged that inline results, meaning results that simply match already elevated expectations, could actually trigger a sell the news reaction rather than further gains, since so much good news may already be reflected in the share price. The fourth risk worth mentioning is geopolitical exposure. Micron manufactures chips globally and sells into markets across the world, including regions where trade policy and export restrictions around advanced semiconductor technology have shifted before and could shift again. Any meaningful change in trade policy affecting semiconductor exports could disrupt customer relationships or manufacturing plans with relatively little advance notice. So what does Wall Street think about all of this? Analyst sentiment has turned dramatically more bullish in a short period of time. Average price targets have been lifted sharply, with some estimates moving from the mid-$800 range to well above $1,400 per share, as analysts cite the extensive multi-year customer agreements, tighter supply conditions, and improved earnings visibility as reasons for raising their models. Micron also continues paying a modest quarterly dividend, a detail that might surprise investors who think of this purely as a high-flying growth stock, and a reminder that this is still, at its core, an established, profitable industrial technology company, rather than a speculative newcomer. Let's talk valuation directly, because just like with SanDisk, the picture is more complicated than the percentage gains alone suggest. On a trailing basis, Micron's earnings per share has grown by roughly 130% per year on average over the past 3 years, while the stock price has climbed even faster than that, meaning the market has been pricing in continued acceleration, rather than just rewarding results that have already happened. That's a meaningfully different dynamic than a stock that's cheap relative to today's earnings. And it means Micron's valuation depends heavily on whether this current level of demand and pricing power proves durable for years, rather than something that fades once the current shortage resolves. So where does that leave us for a final verdict? Micron's fundamentals right now are genuinely exceptional, quadrupling revenue, expanding margins toward levels once considered impossible for a memory chip maker, and a growing base of long-term contracts specifically designed to make future results more predictable. But this is also a stock that has already made one of the most dramatic moves of the entire market this year, in an industry with a long, well-earned reputation for punishing investors during the inevitable downturn that eventually follows every boom. Given all of that, Micron currently sits closest to a hold for investors who've already captured meaningful gains and want to protect them, and a speculative buy only for growth-focused investors who understand memory chip cycles, have a high tolerance for volatility, and believe the shift toward long-term contracted revenue will genuinely hold up through the next industry downturn. Looking 3 to 5 years ahead, the central question for Micron is almost identical to the one we raised about SanDisk. Can these new long-term agreements actually survive a real test, an industry downturn, or a slowdown in AI infrastructure spending? Or will Micron eventually face the same brutal boom and bust pattern that has defined memory chips for nearly its entire 50-year history? If AI infrastructure spending continues at anything close to its current pace, and Micron continues gaining HBM market share from its two main competitors, this could genuinely mark the moment memory chips stop being viewed as an unpredictable commodity business and started being valued more like the essential infrastructure they've quietly become. If the shortage resolves faster than expected, or a broader slowdown hits AI capital spending, a stock that's risen this far, this fast, could give back a significant portion of its gains just as quickly. So let's bring this all together. Micron and SanDisk are proof that the same artificial intelligence boom is creating enormous winners in places most investors never thought to look. The unglamorous memory chip manufacturers, quietly supplying the hardware underneath every AI data center in the world. Micron's specific advantage lies in HBM, the specialized high-speed memory sitting directly inside the AI chips made by companies like NVIDIA, and its aggressive push to lock in years of demand through binding long-term contracts. But dramatic moves cut both directions, and an industry with this much cyclical history deserves genuine respect, not blind confidence. Remember, great investing isn't about chasing hype. It's about making informed decisions. If this breakdown helped you understand the memory chip side of the AI boom, hit subscribe so you don't miss the next one in this series. Like this video if deep dives like this help you invest smarter, and comment below which stock you want us to analyze next. Don't forget to turn on notifications so you never miss an upload. Thanks for watching, and we'll see you in the next one.